We are starting with our IFRS masterclass to enable us solve questions, discuss basic principles when it comes to the accounting standards. So we go straight up into the discussion and we are looking at our very first question here, and you can take a screenshot of the question certainly. That enables you to make reference later. So question number 1, the requirement is A, account for the revaluation in the current year, B, account for the decrease in value, and then C, account for the revaluation and state a treatment for depreciation from 20x8 onwards. And so the first part of the question is the A, the second part of the question is the B, and the third part of the question is the C. So let's see what we do here. So if you look at it, this question here is about revaluations. And so if you remember the principles when it comes to revaluation of assets, what is going to be happening generally is that we are going to be comparing the carrying amount of the asset to the revalued amount. And as you remember, or you should know, what happens is that if our carrying value exceeds the revalued amount, that is going to be an impairment or a revaluation loss. And for the first time, when we revalue assets like this, please, the RA here is not recoverable amount, it's revalued amount, okay? So the first time when we revalue assets and we get an impairment loss or a revaluation loss like this, it's automatically going to be recognized in the profit or loss account. Okay, so for that first time, we recognize the loss in the profit or loss for the first time. Also, if for the first time we revalue assets and it turns out that, the carrying value is greater than the revalued amount, which means that we are going to be getting a revaluation surplus or revaluation gain. Again, for the first time, when we revalue an asset for the first time and we get a revaluation surplus, then it will be recognized in the OCI. So this will be recognized in the other comprehensive income. And so this is the default treatment that we start the discussion with, that when we revalue an asset for the first time and we get a loss, P&L. And so for journal entry purposes, if we want to, it will look like this. We will debit the profit or loss, all right? Then certainly credit the property, plant, and equipment. So that's a journal entry. First time revaluation loss or impairment in the asset. Then if we have a first time revaluation surplus, as I said, we're going to debit the property, plant, and equipment because the value of the asset is going up. And then we credit other comprehensive income, or if you want, revaluation surplus as well in that case. And so that is the default way of how we treat revaluation of assets. The default way, that's the starting point. All right, so that's the starting point. That's the default way of revaluing assets. Now, what happens if we do a first revaluation and then on subsequent measurement, we are now seeing that, the asset is having a different thing? What do we do? And so let's look at that principle as well. Then we can come to our question. So subsequent revaluation. That's what we are having. So first year, we revalue, it was a loss. Now in the subsequent year, we revalue and now it's a gain. Okay. So subsequent revaluation gain. What we do is that the gain will be recognized first in the P&L account up to the impairment loss previously recognized. Any excess amount is recognized in the OCI. That's what's happening here. So on that subsequent revaluation, which results into a gain from an asset that had previously suffered an impairment, what is going to be happening is that first, although it is a gain and by default it's supposed to go to OCI, no, it will be going to P&L first. So the gain shall be recognized in the profit or loss up to the impairment loss recognized in the previous year. Then any excess is recognized in the OCI and revaluation surplus. This is the principle. Okay, so what does that mean? Pretty simple journal entry with debit, and then we're going to credit the profit or loss. Then the excess, which is the balancing figure, is going to be credited to OCI, or revaluation surplus. That is the idea about that. So last year, the assets suffered an impairment. This year, we have revalued and it is a gain. If that gain doesn't go straight up to the OCI, it will be first recognized in the P&L. The excess amount of it is what will go to OCI and revaluation surplus. Then, in the second scenario, which we said we revalued the asset the first time and it was a surplus. So on subsequent measurement, if we do the revaluation and it is now a loss, how do we account for it? Pretty simple here. So now we are getting a revaluation loss from an asset that previously had a gain. Just like how we did the first one, you just flip it up. So the loss will be first recognized in the OCI up to the balance on the revaluation surplus. Any excess is what is going to the P&L account. So the loss is recognized in the OCI against the revaluation surplus relating to the asset. Then any excess amount is what will go to P&L. So here our journal entry will look like this. You debit first revaluation surplus, as we said, with OCI on the line. So it will go to OCI as a negative. Then you're going to credit PPE because the asset is falling in value. The balancing figure is also going to be debited to profit or loss. That is, if the revaluation loss account doesn't have enough balance to take care of the whole impairment or the revaluation loss that we are getting in the subsequent year. So this is how we deal with revaluations.